An enormously important decision. Today's data may have moved the markets, but not the Fed. As expected, they raised their benchmark rate range to a range of by a quarter percentage point to a range of 1 to 1.25%. And also the dot plot that Wall Street takes as a rate forecast still sees one more move this year, between 3 and 4 more next year, which would put the Fed funds rate target at a median of 2.1% by the end of 2018. Their longer-run terminal or neutral rate unchanged at 3%. In their statement, the committee members take note of recent inflation running, quote, somewhat below their 2% target, but they say it should stabilize around the target over the medium term. The committee says it is monitoring inflation developments closely. Their new economic forecast would see PCE inflation of just 1.6% this year, but 2% on average in 2018. One dissent today, Minneapolis Fed President Neel Kashkari. On top of the monetary policy decision, there is also this, a plan for reducing its balance sheet, which Fed officials say they plan to begin implementing this year as long as the economy stays on track. They will taper reinvestments in Treasury and mortgage securities, a cap of $10 billion a month, $6 billion a month initially for Treasuries, increasing in steps of $6 billion every 3 months for a year until they reach a total of $30 billion a month. For mortgages, the cap will be $4 billion a month, increasing $4 billion a quarter until it reaches $20 billion. That will allow, the statement says, the balance sheet to decline in a gradual and predictable manner until the committee judges the Federal Reserve is holding no more securities than necessary to implement monetary policy efficiently and effectively. Well, how much is that? They don't say. The statement notes it will be a level, quote, appreciably below that seen in recent years, but larger than before the financial crisis. Right. It will depend on the committee's demand for reserves and the committee's decision about how best to implement monetary policy. They'll learn more as the unwind proceeds. One more thing. The committee reaffirmed that the Fed funds rate is their primary tool for monetary policy, but they are willing to suspend their reinvestments of maturing securities to bring them back if there's a material deterioration in the outlook for the economy that would warrant a sizable reduction in the Fed funds rate. In other words, if we get to zero again, they'll bring back QE. A lot for the markets to digest.